Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF Conference. And I'm here with Simeon Hyman, head of investment strategy at ProShares. Great seeing you, Simeon. Great seeing you. Listen, yesterday we had a great panel about smart beta. We talked strategy, but one thing you brought up about dividends, it hasn't lost its luster, even though we've seen a bit of a correction so far this year.
Well, you know, Tom, we focus on a suite of dividend growth ETFs, and companies that can continually increase their dividends have strong balance sheets, a strong quality element, and indeed it's true. Back in August and now in January, they performed defensively very well, but they do tend to participate well when markets recover, so it's been a place that advisors have been looking to over the last couple of years.
Absolutely, and it's been great for flow. So as we've seen more volatility in other areas of the market, dividends continue to resonate.
Ticker NOBL, Noble finally passed the $1 billion threshold. I say finally, but only after a couple of years of being out, so it's a big hit for us.
Absolutely. What else are you looking at as far as advisors' interest today?
One of the innovative products that we've launched is S&P 500 ETFs with a sector removed. The, of course, most topical one is SPX, which is SPX Energy. So a very simple opportunity. If you think the bottom's not there for oil prices in the energy sector, you simply have the opportunity to invest in the S&P 500 with the energy stocks removed. It's a simple solution, and we think it's one that's worth looking at these days.
Absolutely. I mean, imagine last year, removing energy out of the S&P would have been record levels, correct?
Yeah, it certainly would have contributed to some better performance for client portfolios.
Absolutely. And also, from an interest rate standpoint, we saw the first rate hike. We heard from the Fed that maybe 4 hikes this year, but all of a sudden consensus is down to 2. Even if we're somewhere in the middle, we need some type of rate strategy, don't we?
Well, this has been a flight to quality.
Yeah.
And of course, the headlines have shown the carnage in the high yield bond market. And so high yield spreads have blown out, and in the meantime we've had a classic rally in US Treasuries, and yields are a little bit lower than they were 3 or 6 months ago. If, and I say this if because I can't tell you when it's going to happen, but if you're starting to think about nibbling at those high yield bonds and you think that the bottom is there and maybe energy prices are going to stabilize, the same factors that will bring in those spreads and push up the prices of those high yield bonds is very likely to also start interest rates rising again. And it's why, if you're thinking about nibbling an interest rate hedged approach to those high yield bonds, which we execute through ticker HYHG, is a place that should be on your shopping list when you think that time for a turnaround in the high yield sector is nigh.
And specifically there, you're long high yield, but actually short Treasury within that component.
We bring it down to 0 duration so you can get the maximum benefit from the spreads coming in, but not get hurt from rising interest rates that are likely to be coincident with that.
Great. Simeon, 3 great ideas, and as always, great seeing you.
Thanks very much for your time.
Thank you.